Welcome to The Explainer. I'm stepping into the role of a professional sell-side equity analyst today, and we are going to rigorously dissect the true fundamental intrinsic value of Mercury Systems, ticker symbol MRCY. Our mission is absolutely critical but pretty straightforward. We're going to strip away all the market noise, look strictly at the numbers, and perform a comprehensive financial autopsy on this company. We're using hardcore valuation models to figure out what Mercury Systems is actually worth.
Okay, let's dive right into this. Mercury Systems is currently trading at a market price of $88.06 per share. But when you look at the raw fundamental data, the estimated fair value sits at a shocking $10.99. I mean, that is a negative 701% margin of safety. Just think about that for a second. The market is pricing the stock at a massive, massive premium compared to its fundamental base. So our job today is to figure out exactly why that is, and honestly to see if the math can even come close to justifying this towering valuation.
To get to the bottom of this mystery, we'll follow a clear roadmap. We'll start with the setup, move into absolute valuation, talk about the models we had to skip, check out relative valuation, look at asset and liquidation values, and finally, deliver the verdict.
Section 1. The setup. Visualizing the clues.
So there's a bizarre disconnect happening with MRCY right now. On one hand, the stock has this incredible momentum. We're talking a trailing 12-month total return of almost 84%. Investors have clearly been aggressively bidding this up. But let's contrast that with the net income compound annual growth rate. Over the trailing 12 months, and actually over the last 3 and 5 years too, that growth is a flat 0%. In fact, over the last 12 months, net income is actually negative $30.41 million. So the stock price is skyrocketing like a rocket ship, but the company's bottom line growth is literally non-existent. That's our very first major red flag.
Section 2. Absolute valuation. The cash flow reality.
We really need to ground ourselves in the cash flow reality here. And the most trusted tool in any sell-side analyst toolkit is the discounted cash flow or DCF model. Let's walk through how we build this out for Mercury Systems. Step 1 is extracting the unlevered free cash flow. Now, despite those net income losses, the company does actually generate positive free cash flow. It's $99.38 million over the trailing 12 months, to be exact. Step 2 involves assuming a weighted average cost of capital, or WACC, which just reflects the overall risk of the business. Step 3, we calculate the terminal value, what the company is worth at the end of our forecast period. And step 4 is discounting all those future cash flows back to figure out what they are worth right now, today.
Now, to build a truly rigorous DCF, we have to address some missing pieces in our source data. When specific forecasts just aren't provided in the filings, a professional analyst must clearly declare their external assumptions. To make this model actually function, we are assuming a standard market risk premium of 5 to 6% and a long-term terminal growth rate of 2 to 3%. These are completely sensible default assumptions that allow us to project that initial $99 million of free cash flow out into the future and discount it properly. So the crucial point here is what happens when you actually run that math. When you take the company's trailing free cash flow and you apply those standard growth and discount rates, the data's own DCF-based fair value calculation pinpoints exactly $10.99 per share. This is the absolute anchor of our valuation. The math simply does not stretch to $88 based on current cash generation capabilities. Not even close. But a good analyst never relies on just one model, right? Let's check our work and see how this builds with 2 other absolute valuation frameworks, the residual income model and the adjusted present value, or APV model. The residual income model starts with book equity and adds the present value of expected future residual income. Basically, it's what the company earns above its required cost of equity. But analyzing MERC's return on equity reveals it's negative 2.08%. When your ROE is negative, you are actively destroying residual value, not creating it. So this model pulls the intrinsic value down even further. Well, what about APV? The APV model values the firm as if it were entirely equity financed and then adds the value of tax shields from debt. But Mercury's debt-to-equity ratio is a highly manageable 0.41. With relatively low debt, the tax shields are just way too small to magically rescue the valuation and bridge that massive gap up to $88.
Section 3. Skipped models. The missing pieces. I want you to think about this for a second. If we are trying to be as comprehensive as possible, why would a sell-side analyst be forced to completely abandon the sum-of-the-parts model and the dividend discount model for Mercury Systems? Well, the answer lies strictly in our source limitations. To run a sum-of-the-parts, or SOTP valuation, we absolutely need distinct business segments with separate operating metrics so we can value them independently.
The filings here just completely lack that segmented reporting data, making SOTP literally impossible. And as for the dividend discount model, well, MRCY's dividend compound annual growth rate is exactly 0%. They don't have a consistent, stated dividend policy to discount back to the present, so we have to discard these models and rely on the ones that fit the data we actually possess.
Section 4, Relative Peer Valuation, the industry context.
Now, what's really interesting about our methodology here is that because our source document doesn't explicitly list direct competitors, we have to make an external, professional assumption. Based on general industry knowledge, we compare MRCY against a basket of publicly traded aerospace and defense tech comparables. We look at the assumed industry averages for these peers to see if MRCY is trading in line with reality. The data reveals some extreme overpricing. Mercury's price-to-earnings ratio is negative 172.67. Why? Because as we saw earlier, their net earnings are negative. While a normal defense tech peer might trade at a positive enterprise value to EBITDA multiple of around 15 times, MRCY is trading at an astronomical 72.16 times EV to EBITDA. Its price-to-book ratio is nearly 3.6. By every relative metric, the market is pricing this company for absolute perfection, despite the fact that it's currently generating net losses.
Section 5. Asset and liquidation value. The worst-case scenario.
When earnings and cash flows are weak, analysts look to the balance sheet to see what the raw assets are worth in a worst-case scenario. This is how we estimate net asset value, or liquidation value. We act as if the company is being completely dismantled tomorrow. We restate the balance sheet, apply haircut discounts to things like inventory and receivables, because you know you never get full price in a liquidation fire sale. We subtract all the adjusted liabilities, and then divide the remaining cash by the outstanding shares.
But here is where the math bites back again. The market is valuing Mercury's enterprise value at 2.22 times its total assets. The market is paying a massive premium for these assets. But look at the net profit margin, negative 5.69%. The market is literally paying top dollar for a collection of assets that, operationally, are currently bleeding cash. The liquidation value provides absolutely no floor that gets us anywhere near that $88 share price.
Section 6. The verdict. Summarizing the valuation. We've run the numbers, we've synthesized the data, and here is the bottom line. The absolute valuation, driven primarily by the discounted cash flow model, firmly points to an intrinsic value of $10.99. Relative valuation shows extreme overpricing, with an EV to EBITDA ratio over 72. Earnings and return on equity are deeply negative, which actively destroys residual value rather than building it. We are forced to conclude that the current $88 price tag is entirely decoupled from rigorous, fundamental intrinsic value. It is relying purely on market momentum, driven by that 83% trailing return. Which leaves us with this final thought. We've left the data speak, and the data tells us the fair value is fundamentally $10.99. So, is Mercury Systems' $88 price tag a massive, dangerous speculative bubble just waiting to pop? Or is the broader market pricing in some radical future transformation that these rigorous mathematical models simply cannot capture yet? I'll leave you to decide. Thanks for joining me on this explainer, and keep your focus sharp.